Hey guys, Lincoln here from bowacademy.org. Today I want to talk to you about stock splits. So I had this video in my pipeline for a couple weeks down the road, but it turns out everyone wants to do a stock split these days. There's Tesla, there's Apple, right? They're trying to capitalize on the psychology behind stock splits because stock splits don't do anything but make you think that it's cheaper to acquire the stock. So people want it more because they think, oh, it's cheaper now, I can afford it. So they go out and buy it, right? So if you make a good thing cheaper, people will say, hey, I can afford it, I'll buy it, why not? So it's all psychological. But of course, there are some reasons for why these stock splits exist. It's just that they are immaterial. They don't really do much for the company's value, and they don't mean anything to the stockholder because the value of their shares are still worth the same. It's just that they have more shares that are worth less each. Right, so let's talk about all of this and why I want you guys to avoid buying the hype of all these stock splits. So as I've mentioned many times on this channel, the price of a stock doesn't really matter. It's arbitrary, right? The value of the company is what really matters because that determines how much people are willing to pay for the company. So the price of a share of a company really can be anything so long as that price times the number of outstanding shares adds up to the market cap, the market value of that company. So a stock split is exactly what it sounds like. The company takes one share and splits it into multiple shares. The underlying goal of a stock split is usually to increase the number of outstanding shares as to allow more people to get their hands on a share of the company, right? Because if there's more outstanding shares, there's more to go around to more people, right? Because remember, a stock is just a share of a company, and if I hold a stock, you cannot also hold it. So if the company realizes that there's more people out there who want to hold their stock than there are number of shares outstanding, the company may consider engaging in a stock split so that they can have more shares to issue to more investors without actually producing more shares and diluting existing shareholders, right? Because they're not actually creating more shares of the company. They're just increasing the supply by splitting out the existing supply of shares on the market, because they can take one share and turn it into 4 shares, or they can take that one share and turn it into 10 shares. They can turn it into however many shares they want, so long as that means there are more shares to go around, but at a cheaper price per share, right? And of course, it's proportional. So if they want to do a 4-to-1 split, then there will be 4 times as many shares outstanding, but each share will be worth only 25% of the previous single share that it was split out from, right? You take a cake and you split it into 4, you still have that same cake, but now you have 4 pieces of it. So each piece of that cake is only worth a portion of the entire cake. That's all a stock split is, right? It's that simple. It's very simple math. You take a pie, you cut it into pieces, you have more pieces of the pie, but the pie is still worth the same. Right? Nothing has changed about the pie. It's just that there's more pieces of the pie to go around, so now more people can have a piece of that pie. That's the whole point of the stock split. And this is where the psychology of the stock split comes in. It's a bit of psychological warfare, if you want to call it that, but these companies know that because they're in such high demand, they can just create more pieces of their shares and sell it to more people. So stock splits used to be a very good way for companies to decrease the price of their stock in order to allow more people to acquire their stock at a cheaper price. Because in the before times, before Robinhood and Webull and other online stock brokerages, you used to have to buy a whole share of a company. If a company cost $1,000 per share, you used to have to pay that whole price to acquire that share. But these days, there's fractional shares. Right? You don't have to pay the whole $1,000 these days. If you want only a quarter of that company's share, then you can pay $250 to get that quarter of a share, right? If the stock costs $100 and you only want a quarter of that stock, then you can pay $25 to acquire a quarter. So there's no barrier anymore for people to say, hey, this stock costs way too much, I can't afford it. I can't afford to buy a whole stock, so I'm gonna just wait until the stock goes down or I have enough money to buy a whole share. You can buy a piece of a share these days, right? Using fractional shares on Robinhood, on Webull, and even other stock brokerages who have come around to the idea. Charles Schwab has come around to the idea, and I'm sure more of them are going to come around to the idea of fractional shares. It's just that people don't know about that yet. So when stock splits happen, investors get excited because they think the stock price is so cheap now, I can afford it. I can buy more shares of this company that I love, but I couldn't afford before, right? But that's not actually true these days. You could always afford that company's stock because you can use fractional shares. So because most investors don't know about fractional shares and how to use it, existing investors in a company that announces that they're going to go through a stock split get excited for that exact reason, because they think more people are going to want to buy this stock, so I'm going to buy it now, and then as the hype comes in, I'm going to be able to sell the stock at a higher price than what I bought it for. Again, this is hype. This is FOMO, the fear of missing out. They think that people are going to have a fear of missing out on this newly cheap stock, so they buy the stock early as soon as the company announces that they're going through a stock split, hoping that people will want to buy the stock on the hype as well. And because they can get in early, as the price goes up, they'll be able to sell the stock at a much higher price than what they got it for, right? These are people taking advantage of the psychological effects of a stock split. They know it doesn't do anything material to the value of the company, but they also know that most people think a stock split actually does something to the value of the company and will make the company worth more. So when the company announces the stock split, the price of the shares might actually go up just on the hype alone. But eventually it will go back down to where it's supposed to be, the actual value of the company before the stock split was announced, right? So don't buy on the hype. Don't buy on the stock split news. If you're investing in great companies and planning to hold for the long term, you don't have to try to game the hype or the FOMO. You can just hold your investment and count on the long-term appreciation of the assets that you invest in, right? Of course it's going to be hype, of course it's going to be FOMO, but if you buy on the way up, you're going to be disappointed when the stock comes back down, right? When the hype dies off. So that's why when I hear these stock splits, I think, oh God, here we go again. People are going to get excited. They're going to buy all the hype. They're going to buy all the FOMO. And they're going to lose a lot of money because they thought the company's value actually changed. Nothing is changing about the company. The company is still worth the same. There's nothing changing. The company is still fundamentally the same. All they're doing is playing with people's minds, right? Of course, if people think that the stock price is cheaper, they'll buy it more. I have to admit, I do the same thing. I want more shares, right? Just psychologically, I want to be able to say, I own 10 shares of this company rather than 1 share, or I own 100 shares rather than 10 shares, right? It's just psychological. We're human. We have emotions. We have ego. We want to say we own more of something than less of it, right? 100 sounds better than 10, right? 1,000 sounds better than 100. So it's psychological. It works, but you have to fight against it. Don't buy the hype. So that's what a stock split is. That's how it works. If you have a single share and a company says we're going to split our shares into 4 shares, 4 to 1, then you're going to turn that 1 share into 4 shares, right? If you own 1 share of a company, it turns into 4 shares, right? But each share is only worth 25% of the previous 1 share. So nothing is changing about the value of your asset. If you owned $100 of that company before, you still own $100 worth of that company after the stock split, right? It's the same value. It's just that there's more shares to go around. Now that you have 3 extra shares, maybe you will realize that, hey, maybe I don't need all 4 shares. I'll sell off 2 of them and keep the other 2, right? So now more people can actually buy the shares. That's the whole point. It's still worth the same, but more people can get their hands on a share of the company. So I hope that helped you understand what a stock split is, how it works, why companies undergo this seemingly immaterial process. But again, it has a psychological effect on all of us, and it's very real. It definitely works on all of us because we're human. But remember that if you're investing for the long term, so long as you continue to hold, you will benefit from the eventual appreciation in the value of your assets, even after the stock split takes place. And of course, the stock split can go both ways. If people think that the stock split is going to have a positive effect on the perception of the company, on how easy it is to acquire a share of that company, then there will be positive hype. But if people think that the stock split might have a negative effect on the perception of the company, then people might get afraid and sell off their shares, right? And then there's going to be negative hype. The price of your shares is going to go down, and you might think, oh my God, I'm losing money, and you might want to sell. Remember that if you're holding for the long term, if you're investing for the long term, all that matters is how long you spend in the market, not if you get the best deal on the price of your stock. So long as you're investing for the long term, the short-term hype and FOMO cycles shouldn't matter to you, right? Remember to always practice the bull mentality. The bull mentality is that we know what we invest in. We understand what we invest in. We believe in what we invest in. And we hold for the long term. So long as you're doing that, that's how you build long-lasting, sustainable wealth, right? That's how we win and give ourselves the best chances at success in the stock market. So thank you for watching this video. If you enjoyed it, remember to like this video down below, subscribe to the channel, hit the notification bell so you know when we publish a new video, and comment what you've learned and what you would like to learn in the next video that you want me to explain. And I hope to see you in the next video. Thank you again and have a great day.